Welcome to this explainer. If you've ever felt like the Australian property and mortgage market is just this rigged game where the rules are kept totally secret from everyday buyers, well, you are absolutely right. Today, we're peeling back the curtain on the opaque mechanics of this industry, and we're going to break down the exact secrets lenders keep hidden, the stuff banks really don't want you to know.
Over $200,000. Yeah, you heard that right. That is the staggering potential cost of the mistakes first-time homebuyers make simply because they just don't know the rules of the game. Industry insiders have watched countless buyers literally bleed away their hard-earned deposits and future equity through completely avoidable errors. It's a massive, massive penalty for simply not being an insider.
So this brings us to the real elephant in the room. Are lenders actively keeping your money? I mean, we all kind of want to think our lender is our partner in buying a home, right? Like a helpful institution facilitating our dreams. But today, we are going to explore whether a lack of insider knowledge is actively draining your wealth straight into their profit margins.
Section 1. What lenders actually want.
Let's completely redefine a phrase you probably hear all the time: borrowing power. When banks assess your application and spit out a number, they aren't looking at your dreams or even your true potential for wealth creation. They're strictly looking at risk mitigation through their own highly protective lens. Your borrowing capacity, it's merely their mathematical safety net.
Because, look, despite the absolute mountain of paperwork that makes you feel like you're signing your life away, lenders really only care about two fundamental things. First, reliable servicing. Basically, can you predictably pay them back every single month? And second, secure valuation. If you can't pay them back, is the property worth enough for them to easily sell it and recoup their money? That's it. Everything else is just noise.
Now, here's a secret lenders will absolutely not tell you up front. Having a few blemishes on your credit doesn't always mean a hard no. Actually, it usually just means they've found a great excuse to adjust the pricing. They use your credit score as leverage to trap you into a higher interest rate, making your loan significantly more profitable for them. So your past financial mistakes literally become their future dividends.
Section 2. The interest rate trap.
So there is this deliberate and, let's be honest, highly profitable disconnect that trips up so many buyers. The Reserve Bank of Australia's official cash rate, that's what makes the evening news. But the actual mortgage interest rate you see on your statement is a completely different beast. Banks use the confusion between these two numbers as a smokescreen to quietly address their own margins.
Think about it. When the RBA announces a rate cut, everyone cheers, right? But who actually gets that money? Well, as you'd probably expect, banks notoriously retain the lion's share of those savings to pad their own profit margins. The tiny leftover slice is what actually gets passed on to you, the consumer. They rely entirely on your complacency to boost their bottom line.
And the real-world impact of that complacency? $41,000. By not aggressively chasing down your lender to pass on just a single unpassed rate cut, you could be letting the bank pocket up to $41,000 of your hard-earned money over the life of your loan. That is, quite literally, the price of silence in the mortgage market.
Section 3. Hidden costs and real estate traps. But hey, the bank's behavior is only one side of the coin here. The real estate market itself is loaded with traps. Get this, according to industry insiders, a shocking 85% of homes on the market are literal money pits. I really want you to absorb that. Nearly 9 out of 10 properties will actively drain your bank account through hidden flaws, poor capital growth, or unexpected repairs. Finding a good property isn't about looking for a needle in a haystack, it's about actively dodging landmines.
First home buyers consistently miss a whole bunch of hidden costs. We're talking about crippling lenders' mortgage insurance, which, by the way, is a hefty fee you pay to protect the bank, not yourself. Then you've got building and pest nightmares that conveniently never show up during the open house. Add in unseen stamp duty taxes and incredibly frustrating delayed settlement fees. Any single one of these can completely evaporate a deposit that took you years to save.
Section 4. Insider hacks to win.
Okay, let's take a breath. It is time to flip the script. You can mathematically eliminate 90% of those bad property investments by following a really strict, emotionless, step-by-step filtering hack used by top brokers. Step 1, remove all emotion. Step 2, run the hard math on growth versus yield. Step 3, validate it using the sister suburb strategy to find undervalued areas right next to booming ones. And finally, never sign anything without ironclad finance and building clauses to protect your exit.
Once you do find that perfect property, the real secret is how you structure your finance. We are talking advanced tactics here that average buyers almost never hear about. Debt recycling, using self-managed super funds, leveraging trusts, and properly executing equity releases. These aren't just fancy buzzwords, they are the architectural blueprints for serious wealth.
Let's zoom in on debt recycling for a second, because this is huge. It's a brilliant strategic maneuver that legally transforms your bad, expensive home loan debt, the kind that gets you absolutely zero tax breaks, into good, tax-deductible investment debt. It legally shields your income and massively accelerates your wealth creation by making the tax system actually work for you instead of against you.
And wow, it gets even more powerful. By leveraging self-managed super funds and trust structures, savvy investors can legally sidestep massive capital gains tax grabs. In fact, top brokers have shown how structuring a purchase through a trust or an SMSF can save investors upwards of $88,000. I mean, that's not pocket change, that's the entire down payment on your next property, saved purely through strategic structuring. Ultimately, this all comes down to a massive mindset shift. See, while average consumers are absolutely terrified of negative equity and high interest rates, the rich look at it entirely differently. They actively use strategic, structured debt as their primary tool to build massive property portfolios. They don't fear debt, guys. They optimize it.
So, as we wrap up this explainer, I really want you to ask yourself a hard question. Is your current home loan strategy building your wealth, or is it just quietly enriching your lender? Because the cost of staying in the dark, the cost of doing absolutely nothing, well, that's exactly the secret the banks hope you never figure out. So what's your next move going to be?